IMOS 4472 team. In this video, I'm going to take you through chapter 15, which is our fraud chapter. So let's get started. I will share my PowerPoint presentation with you, and let's talk about fraud. For all of you who have taken the fraud course, this will be a review. For everyone else, I will take you through everything you need to know to be successful in this course. So in this chapter, we're going to talk about the various types of fraud, how accounting professionals manage the risk of fraud, how to identify and prevent asset misappropriation schemes, and the impact that fraud has on financial statements. Okay, let's identify the main types of fraud. So before we identify fraud, let's talk about what fraud is. Fraud is the knowing misrepresentation of the truth or concealment of a material fact to induce another to act to his or her detriment. This definition has 4 elements. So our first element is that there's a false statement. So the perpetrator either lies directly or hides the truth. So concealment of truth can also be considered fraud. Then there has to be knowledge. And knowledge means that the perpetrator knows that the statement is false at the time that they state it. So the perpetrator must know that they're lying, or a reasonable person would know that they're lying. Reliance means that the victim relies on the information when deciding or acting. So the victim trusts the perpetrator. And then there has to be damages, and damage means that the victim suffers damages as a result of relying on this false statement. So the victim is hurt. So for example, with financial statement fraud, if investors rely on financial statements and managers falsify statements, then this is considered fraud because investors use financial statements to make decisions. And if they make the incorrect decision and this results in investment losses, then the management might be accountable for fraud and might be actually having fraud trials. Fraud is a risk. So many risk management professionals underestimate or ignore fraud risk at a corporate level. This is because a lot of fraud is unreported and a lot of fraud is small fraud. However, companies can manage fraud proactively by performing fraud risk assessments. So looking where are the vulnerabilities in internal controls. They can create an anti-fraud culture. So if you have an organization that is high in ethics and prosecutes anyone who does commit fraud, then this creates an anti-fraud culture. You can promote fraud awareness through employee training. So you can train employees about fraud, some of the risk factors surrounding by fraud, some red flags that might identify individuals that are prone to fraud. And by having this type of training, employees can monitor each other. And then you can obviously establish and maintain an effective system of internal control. So having an internal audit department and constantly doing internal controls audits to make sure that there are no system vulnerabilities. And if there are vulnerabilities, they can be addressed. And then you should also institute a formal fraud investigation process, including whistleblower hotlines where employees can anonymously call and report fraud. Fraud risk assessment. A fraud risk assessment can be integrated into the enterprise risk assessment or performed as a standalone process. So it can either be done together or alone, depending on the company's risk appetite. During a fraud risk assessment, fraud risks are usually categorized as either financial, operational, or compliance risks. And like all other risks, fraud risks are addressed by creating a risk response and implementing internal controls to mitigate the risks of fraud. And companies should address fraud risks since fraud can significantly impact profits and the reputation of the organization. There are different types of fraud. There's internal fraud and external fraud. Let's start by discussing external fraud. External fraud is fraud perpetrated by customers, vendors, or other outside parties against a company. Since they are an external risk and less preventable, companies often devote significantly less time to them in risk assessment. Because it is done by outsiders, you can't build as many controls, although you can build controls based on what your customers and vendors pay and having clear systems that have everything documented. Documentation and various system security are a key. So for example, when a vendor sends you inventory, you can count it to make sure that it complies with the order and it's the appropriate sort of inventory. Occupational fraud is also called internal fraud, and this is the fraud that most organizations focus on because it's committed by either owners, executive management, or employees of a company who use their positions to enrich themselves at the expense of the company. The ACFE identifies almost 50 different types of occupational fraud schemes. If you are interested in fraud, I strongly suggest you take the fraud course that Dan Management offers to learn more about them. There's 3 categories of occupational fraud. We have corruption, which includes items such as conflict of interest, illegal gratuities, bribery, and economic extortion. Then you have asset misappropriation, which could be either fraud related directly to cash, fraud related to inventory and all other assets. So this can be occurring at the time of sale. And then we have the bigger fraud issue that was in the media, especially in the early 2000s, which is the financial statement fraud. And this occurs when organizations overstate their financial performance or understate their financial performance to meet certain objectives. So corruption is the inappropriate use of influence to obtain a benefit contrary to the perpetrator's responsibility or the rights of other people. And there are 4 types of corruption fraud schemes, such as conflict of interest. So for example, if one of the vendors is your brother and you give them the contract, even though they might not provide the best price or benefit for the organization. Illegal gratuities is basically when a vendor receives payment. Sorry, when a vendor receives a contract, they provide the supplier or the person in charge of contract management something extra on the side. Just like you would tip a waiter, the vendor might tip the person in charge of contracts. Commercial bribery is when a vendor comes to a purchasing person and says, you know, if you provide me with this contract, I will give you a new car, maybe a piece of jewelry, a vacation. So it's a if-then exchange. If you do this for me, then I will do this for you. Economic extortion happens when the person in charge of purchasing and contract management goes to the vendor and says, I will only provide you with this contract if you give me this. So commercial bribery is instigated by the external party, so the vendor, and economic extortion is initiated by an employee inside the organization, usually the manager of purchasing or contracts management. So we have types of corruption schemes. So conflict of interest, employee prioritizes their personal interests over those of the organization. And this results in an adverse impact on the organization, and the relationship or the activity that the person engages in is in conflict with the employer's interests. So the example that the textbook gives is a purchasing manager awards a contract worth $2 million to a firm owned by a family member. Illegal gratuities occur when executives, managers, or employees give or receive something of value as a reward for favorable decision making. The example the text gives is a purchasing manager awards a contract for $2 million to a vendor, and afterward the vendor delivers an expensive vehicle to the purchasing manager. Commercial bribery occurs when employees accept a covert offer of payment or something of value for favorably influencing a business decision. The offer is always made before the decision without the employer's knowledge, and merely making an offer is illegal. So just the vendor making an offer of bribery is considered an illegal act. And the example the text gives is a vendor offers to give the purchasing manager an expensive vehicle if she awards him a $2 million contract. So if you give me the contract, then I'll give you the car. And then economic extortion is when an employee threatens someone to pay up or else bear the consequences. So I said this is instigated within the organization, and the textbook example tells us that the purchasing manager demands that the vendor buys her an expensive vehicle in exchange for this $2 million contract. When you think about fraud and who will engage in fraud, you can look at some behavioral red flags. The presence of these red flags does not mean that a fraud is committed, but these are warning signs for potential fraud. And our text defines behavior red flags as clues that indicate the possibility a person may be involved with a fraud. So please, the key point here is that there's a possibility. It is not a guarantee. It's just individuals you should look out for. And the 6 common red flags that our text talks about are financial difficulties. So if someone is having trouble paying their debt, or there's some additional expenses such as a loved one being sick and paying financial costs for medical, that could be a red flag that that person might be vulnerable to commit fraud. If someone's living beyond their means, so let's say they're admin assistant and they're wearing Gucci and Prada, that might kind of raise eyebrows. How can this person afford these things? If there are overly close relationships with vendors or customers, you might wonder, is this conflict of interest, or is there some other type of fraud occurring? Another behavioral red flag is divorce or family problems, because usually during divorce, finances are tight when a person goes from a 2-income household to a 1-income household. If a person shows control issues or unwillingness to share duties. So for example, if you have an employee that refuses to go on vacation and hasn't been on vacation for 10 years and doesn't want to train back up or show individuals their processes, this is a red flag because they may be hiding something. And then unscrupulous big shot attitude. This is particularly prominent in CEOs and financial fraud when people behave overly confident as if there's nobody like them and they're the best. Okay. Now let's talk about the fraud triangle. The fraud triangle is a framework that is associated with 3 motivational elements that are generally associated with fraud, and research shows that fraud usually occurs when these 3 elements work together. So the 3 elements for committing fraud are perceived pressure or incentive or motive. So the individual feels like they need to commit fraud. So for example, they're behind their mortgage payment and they're going to lose their house, so they commit the fraud. There's that pressure of losing something or not being able to gain something. Opportunity, and usually opportunity involves a weak or at least an inadequate internal control system. So the person, it has the ability to commit the fraud and go undetected. And then there's a rationalization or an attitude. The individual committing the fraud can talk themselves out of the situation and make it seem like it's not bad and what they're doing is right. So for example, one of the rationalizations that people use for fraud is, I'll pay the money back later. I'm not stealing it. I'm just taking a loan. Another common rationalization is disgruntled employees might say, oh, I'm not being paid enough. By taking this money, I am actually acquiring what I'm worth. So they have a justification. Rationalization is basically a justification. So in auditing, these 3 elements of the fraud triangle are referred to as fraud risk factors. Where fraud have occurred, these risk factors were evident after the fact. So for example, if you look at an organization that was a victim of fraud, you will be able to identify all 3 elements of fraud. So the perceived pressure on the employee has the opportunity to commit the act, and then post hoc, the employee can rationalize or justify the act. As I mentioned, perceived pressure is a motive or an incentive that pushes a person towards the decision to commit fraud. A potential fraudster believes they have a need that is non-shareable. Individuals feel that they can't share this need with anyone else, which adds to their perceived pressure. So it's usually a secret. So another perceived pressure might be gambling debts that a person needs to get out of. Forms of perceived pressure. So perceived pressure can come in many forms. For example, the inability to pay debt, the need to maintain a certain lifestyle, keeping up with the Joneses effect, habits such as drugs or gambling, feeling underpaid or underappreciated at work, or a challenge to beat the system. The lower a person's integrity, the less pressure it takes for that person to commit fraud. Then the most critical thing is opportunity. Without opportunity, there can't be a fraud. Opportunity arises when a potential fraudster reasonably expects that the fraud will go undetected and to experience no negative consequences. Nobody wants to get caught. Nobody wants to go to jail. They commit fraud because they believe they can get away with the action. Opportunity is created under certain circumstances, such as when the company has poor or no internal control, when there is collusion, so multiple employees work together to circumvent the internal controls that exist. And lastly, when management actively overrides the internal control. Rationalization, a fraudster who recognizes the opportunity for fraud typically must justify the act of committing it. Rationalization causes a potential fraudster to believe the crime is justifiable before they commit it. And most people must rationalize committing fraud to overcome their consciences. How do we prevent fraud? Preventing fraud before losses occur should always be the priority over detecting fraud after it happens. So prevention controls are better than detection controls. Prevention is the most cost-effective approach in fighting fraud. In addition to assessing fraud risk, an effective fraud prevention approach includes a strong system of internal controls and creates a culture of ethical behavior in an organization. So internal controls, while internal controls are essential for fraud prevention, a company's culture is equally important. An overarching part of a company's control environment is its culture surrounding fraud. So the tone at the top is the culture of an organization that flows downstream from executive leadership to impact all functional areas. So if you have management that models appropriate behavior, does not tolerate fraud, rewards ethical decision making, this should trickle down to all employees. And if you have an ethical culture, chances are you're able to eliminate or decrease the instance of fraud. So here is an example. Poor tone at the top, according to the study, was the primary risk factor in 22% of all financial statement fraud. And then this is broken down by the different types of financial statement fraud. So we have asset misappropriation, corruption, and financial statement fraud. Detecting fraud. Companies implement specific controls to detect fraud. This includes identifying non-behavioral red flags at a process or entity level, setting up anonymous whistleblower hotlines that employees can use to report fellow employees or their managers without fear of retaliation. Data analytics can be designed to continuously monitor processes and systems for fraud trends or anomalies. This is especially helpful when you're looking at various trends in sales or inventory, and this can raise flags. Conducting independent checks of people's work. So by auditing employees' work, you are able to prevent fraud. And then reviewing adequate documentation that leaves an audit trail. So making sure that every process is documented and multiple documents can be verifiable to ensure that everything's recorded correctly. Financial statement analysis. There's two types of financial analysis that are important to identifying red flags that may indicate financial statement fraud. One is horizontal analysis, and this type of analysis involves investigating the changes in financial statement items by comparing two or more financial statements from different periods. So if things look different between 2021 and 2022, and there's no logical business justification for the changes, this can raise a red flag. You can also do vertical analysis, and this type of analysis involves calculating each line item in the financial statement as a percentage of another line item in the same financial statement. This is especially helpful in conjunction to horizontal analysis, so you can see the trends in the percentages and how different they are. So here we have an example of a top-down method of detecting fraud, and it seems like the most effective is a tip line, and it seems that the people that use tip lines the most are employees, followed by customers, anonymous people, vendors, others, competitors, shareholders, and owners. Now let's talk about how to identify, prevent, and detect asset misappropriation scheme. So let's first define what an asset misappropriation is. So asset misappropriation is the theft of corporate assets, including cash, inventory, fixed assets, and information such as customer lists and intellectual property. Asset misappropriation can impact the company's financial statement, specifically when the perpetrator creates fraudulent journal entries to conceal the theft. For this reason, asset misappropriation is one of the two types of fraud that external auditors and the CFE or CPA exam focuses on. When you look at statistics with financial loss due to asset appropriation, it seems like it's the most common, but also the least costly type of fraud. So 86% of all fraud cases are asset misappropriation, but the median loss is only about 100,000. That is because employees are either stealing inventory, cash, or capital assets. So they're limited to how much they can take away quickly. One of the types of asset misappropriation is skimming, and this is the most difficult type of misstatement to detect based on a non-recording of transactions. So it's difficult to detect skimming because the transactions aren't even recorded in the system. So there is no record of any transaction. When a transaction is never recorded, investigators and auditors have no starting point as a reference. And skimming occurs when an employee steals cash before their cash is recorded in the accounting record. So for example, you make a sale to a customer, you collect the cash, you provide them with the inventory, but you never enter the purchase into the cash register or give the employee a receipt. Oftentimes, we as employees might say, oh, a receipt isn't required, I don't need one. But by saying you don't need a receipt, you might be actually helping and aiding employees to commit this type of fraud. So here is an example. As I stated, you have a transaction occurring, the employee is pocketing the cash and they're not even recording it in the cash register or point of sale system. So here is an example of this type of fraud and what kind of controls can be used to deter it. So concealment method occurs when an employee does not ring up a transaction in the sales system. Preventative controls that can be used to prevent this type of fraud is not accepting cash at stores or checking customer receipts when they exit the store to make sure that they actually have a receipt and the transaction took place. Whereas with detective controls, you can do inventory counts and there will be inventory missing. And if there's no cash receipt to indicate that something sold, then you can investigate further. And you can look at specific employees that are working when inventory goes missing and see if you can trace it to a particular employee. You can have an opportunity is the employee pockets cash payment from face-to-face sale without ringing the transaction. One way they can conceal this is to write off missing inventory as expired. Ways to prevent this is to require your manager to approve all write-offs and implementing segregation of duties so that employees who are making the sales are not performing any inventory write-off. So you have two different employees. So in order for this fraud to occur, then you would need collusion. Detective controls, you can use data analytics in this case by comparing the expiration dates on the company's database to when the products are written off to see if the dates conflict. or if items are written off before their expiration date, that raises a red flag. And then you can summarize inventory write-offs by employees to determine if specific employees are performing excessive write-offs. Another way to conceal skimming is to include product inventory count when it isn't there. And the best way to prevent this is implementing segregation of duties so that employees executing sales do not perform inventory counts. And for a detective control, you can have audit teams performing independent inventory counts. And that usually happens with auditors at the end of the year. Accounts receivable skimming is another type of skimming, and it occurs when an employee receives a check from a customer that is meant to settle the customer's balance, but the employee pockets the check and cashes it for themselves, and then they can write off the accounts receivable as a bad debt. And without proper controls, the company wouldn't know the money was missing because there's no document that the transaction exists or that the company actually received the check. So the controls, writing off accounts receivable balance as bad debt. You can implement segregation of duties so that employees receiving payments don't write off bad debt. And you can rotate employees across roles in the department on a regular basis to ensure that the same employee is not in charge of AR all year. For detective control, we can use data analytics to compare accounts receivable write-offs over time for different customers to identify any unusually high write-offs. So for example, if my customer is ABC company, and for the last 5 years, they have paid off their AR in a timely manner. And this year we're writing it off, and we know there's no industry or shocks that the company experienced that would prevent them from paying inventory. You would need to investigate. You can also use data analytics to summarize account receivable bad debt write-off by employees to determine if there's any employee that's performing excessive or above average write-offs. Another thing that can be done is to divert invoices and late notices so customer doesn't receive notices of payments not being recorded. So a prevention control to do, once again, segregation of duties so that the employees that send invoices don't also send late notices, rotation of employees, and then you might need independent or supervisory checks to make sure that these notices are going to the right address. Now we're going to talk about larceny. Larceny is the theft of company assets after the company has recorded the assets in its books. Cash larceny is stealing cash. Non-cash larceny is defined based on the concealment method the perpetrator uses. You can use unconcealed larceny, where the employee does not make an effort to conceal the theft, they just steal the items. Or you can have fictitious sale larceny, when the employee creates fake sales receipts for stolen items and pretends that a sale existed when it didn't. Some control methods for cash larceny: when an employee pockets cash from the register, they're not doing anything to conceal it. Preventive controls is not accepting cash as a payment. Requiring employees to have separate cash drawers, using cameras to record the actions of cashiers, using locked cash deposit bags and segregation of duties between locking the bag and submitting the deposit to bank. So there's a paper trail. And detective controls are reconciling the cash registers to sales received whenever a shift ends and a new cashier starts, so you can see who has discrepancies. And if there's one cashier that always has discrepancies, then obviously it's a red flag that they might be committing fraud. Cash larceny, when the cashier actually takes the steps to write off the inventory as expired. You might require manager write-offs as a preventative control, implementing segregation of duties. So the employee that makes sales doesn't do inventory write-offs, helps to prevent this type of fraud as well. Detective controls, you can have data analytics looking at expiration dates in the company's database based versus write-offs to identify if there's any conflict, and also summarizing inventory write-offs by employees to determine if any specific employee is performing excessive write-offs. Then we have fraudulent disbursements, and fraudulent disbursements occur when an employee causes the business to make a payment for an inappropriate purpose. These schemes are the most common type of asset misappropriation. They occur on the books as the company will have a record of the payment and an audit trail. Proper controls and the use of data and the analytics can help to identify this type of fraud. The most common asset reimbursement scheme is expense reimbursement. So in an expense reimbursement scheme, the business reimburses the perpetrator for expenses that they never incurred. So you might submit an expense claim twice and get reimbursed twice. And this is what double dipping is. It's involved submitting a valid credit card expense 2 times. Once as a credit card transaction and once as a cash transaction. So here's an example of double dipping. You pay for a meal with a company credit card. The company pays the credit card, but you also submit the same meal as a cash reimbursement and you get cash for the meal. Common red flags related to expense reimbursements are with dates outside the date of travel. So with expense categories that do not match vendors or services, or for the same amount and date would signify double dipping. Classified as cash for categories that are not usually paid in cash, such as hotels, airlines, car rental, taxi, and ride share, while also submitting mileage for your car. Airline costs submitted twice, once before the trip, once after the trip, and just under the threshold of requiring receipts. So organizations might ask for receipts for all purchases. So here is an example of double dipping involving a flight. So a person's going on a trip on April 8th. They submit their reimbursement expense prior to the trip. And then once they come back home, they might submit an expense reimbursement for the same flight. So here we have an employee submits a credit expense for an inappropriate personal purchase made on Amazon. The concealment method can be categorizing the expense as a business meal and creating a fictitious receipt. Preventative controls might be requiring receipts to be submitted for all expenses over a certain dollar threshold and having management approve and review attached receipts to make sure that they look legitimate. And then you can also use data analytics as a detective control by comparing merchant code, a categorical code attached to all credit card transactions to reconcile to the location where the credit card purchase was made, to the expense category submitted. And this is helpful because online retailers have different codes, for example, than restaurants. Now let's look at fraud payroll scheme. So in a payroll scheme, the business pays the perpetrator for time that they actually did not work. These schemes come in many forms, from a friend punching a time clock for his buddy at a warehouse to payroll clerks creating ghost or fictitious employees in the payroll system. So the perpetrator also must manage the bank account of the fictitious employee, who may be a real person not employed or the company, or whose social security or social insurance number in Canada has been stolen. The concealment method is none, and we have a cashier pads their timesheet with unauthorized hours every sheet. Preventative control might be to require employees to clock in and out in real time rather than writing their hours on a timesheet. And detective controls using data analytics can be used, and data analytics can summarize the hours worked by employees across different stores with similar titles and compare the results for the shifts to see if there are schedule variances. So for example, if you have employees at the same store opening and closing, and one works 8 hours and one works 10 hours, there might be a problem and a red flag to investigate further. Billing schemes result in fraudulent payments to vendors. So an employee might create fictitious vendors, also known as shell companies, and use them to receive payments for false invoices. Billing clerks can also change the bank information for vendors, typically for a short period of time, to divert payments to the actual vendor to their personal bank accounts. So some of the control activities that can be used to mitigate this, if an employee makes fictitious invoices, you can maintain rigorous control over the vendor's master file to make sure that very few people have editing rights. And if there are changes made, those changes need to be approved by someone. Implementing segregation of duties so that employees that are responsible for vendor creations in this system are not responsible for issuing payment. Requiring managers' approval for checks issued. You can also use data analytics as a detective control by looking for unusually similar vendor names, comparing vendor names and bank accounts, phone numbers, and addresses in the employee directory to see if there's any similarities, and have data analytics looking for post office boxes or incomplete address information that might signal a fraud. Now we're going to talk about the last fraud, and the one that probably gets most of the media attention, which is financial statement fraud. So financial statement fraud involves materially, and the key is materially, so it has to be significantly, misrepresenting the financial results and positions of a company by manipulating amounts or inappropriately disclosing information in the financial statement to deceive the investors, creditors, and other users of financial statements. Materiality means that the misrepresentation is large enough that users who rely on the misrepresented financial information to make this decisions may suffer financial damage. So the misrepresentation has to be significant. So for example, a company would not comply with their debt covenant if they didn't misreport, but they are complying with the debt covenant because they misreported. So that is a material change because different decisions would be made. So they would keep their debt versus their debt would be revoked and they would have penalties. The cost of financial statement fraud are quite large compared to asset misappropriation schemes. As we saw with asset misappropriation schemes, the medium median loss was 100,000. With financial statement fraud, you have a median loss of almost $1,954,000. However, financial statement fraud is a significantly lower proportion of all fraud cases, and only 10% of the fraud cases are financial statement fraud. There's two types of financial statement fraud companies may engage in when they're overstating financial performance. One is overstating assets, revenues, and profits. So this one deals with the asset side of the balance sheet, and you are showing that you have more assets, cash, accounts receivable, and in turn more revenues and in turn profits, right? Because revenues and profits are closely tied together. The second kind of financial performance overstatement includes decreasing or understating liabilities, expenses, and losses, because remember, revenue minus expenses equals profits. So if you have lower expenses, that means you'll have higher profits. There are several ways to fraudulently overstate revenue. One of them is sham sales, in which perpetrators conceal fictitious revenue fraud with falsified documentation. So you make these fake sales that don't really exist. Another one is through unauthorized shipments, and this enables companies to overstate revenue by creating sales and shipping goods that were never ordered by customers. So once again, they're fraudulent sales, but these sales actually are accompanied by shipments of inventory. Another way to overstate revenues is engaging in channel stuffing. And when you channel stuff, the seller encourages the sale of extra inventory to increase the current year's sales, when it is stated or implied that the customer can return the goods after year end, but not providing a reserve against these expected returns in the current year. So remember that organizations always have to look at sales returns and allowances. So by making these huge sales at the end of the year and not building a reserve, you are overinflating revenue. And then the other way to engage in revenue overstatement is looking at sales cutoffs, and that involves recording sales that occur after the balance sheet date in the current year's financial statements to inflate sales, even though they belong in the subsequent period. So basically shifting next year's sales into the current year to inflate the revenue and profits of the organization. When it comes to sham sales, how do you conceal sham sales? Well, by shipping goods to another location. Preventative controls to negate this type of behavior include requiring approvals for moving all finished inventories. Detective controls can be performing simultaneous location inventory counts, so you know precisely how much inventory is in each location. Using data analytics to trace the life cycle of a product throughout the enterprise system, so knowing where the product is. And then implementing vertical or horizontal financial statement analysis that will show that, hey, our revenues are really high compared to previous years. What's going on? Another concealment method is creating a fake customer or falsifying sales documents and then hiding inventory from auditors. Ways to prevent it is requiring approval for creation of new customers in the system and implementing system controls that prevent the creation of customer with similar names so that fake customer accounts cannot be confused with legitimate customers. And our detective controls are using data analytics to review the master customer list for red flags, such as sales only occurring near the end of the accounting period to a certain customer. Unusually high sales near the end of the accounting period, long periods with no sales, and then abnormally large sales without any explanations, and similarity in customer names to legitimate customers, but missing other data fields. The other concealment is shipping to a customer product that was not ordered at the end of the accounting period. Ways to prevent this is implementing segregation of duties so that the person who processes sales receipt does not prepare shipping requests. And then you can also detect this type of fraud through using data analytics to review sales made at year end for unusually large amounts, especially related to cut-off debt, and implementing vertical and horizontal financial analysis. Another thing you can see is management ships more products than were ordered into distribution channels to inflate sale revenue and do not provide reserves for the returns that might come. How is this concealed? By recording sales with the expectation that they will be returned, but not providing for the returns in the current period, so not building up that reserve. Preventative controls that can stop this is ensuring an ethical control environment, creating whistleblower hotlines that employees can report this behavior. Detective controls that can detect that there's a problem is using data analytics to review sales made at year end for unusually large amounts close to the cutoff date, and for unusually large amount returns after the cutoff date. So if you have huge sales in December and then lots of returns in January, that signals a problem. And then comparing sales this year to previous years and looking at them as a percentage of various financial statement items and engaging in vertical or horizontal financial statement analysis. Then we can have management uses sales cut-off manipulation to inflate sales revenue. How do they conceal this? Record sales from subsequent accounting periods in the current period. How do we prevent this? Implementing controls for recording and manipulating journal entries past the cutoff date. Segregation of duties when it comes to the general ledger, and requiring approvals in the general ledger system for big transactions. How can we detect this? Well, we can use data analytics to review journal entries around certain dates and cutoffs, and then using vertical and horizontal financial statement analysis. So here's an example of sales cutoff illustration. So you're moving sales that should happen in year 2 in January to year 1 in December by changing the sales date. Another type of fraud management can engage in is understating liabilities, expenses, and losses. So understating expenses is a common scheme because expense ledger accounts reset to 0 at the beginning of each year due to closing entries. Some common ways management might understate expenses is rather than report certain costs as operating expenses, they can capitalize those expenses and recognize the cost as capital assets and then depreciate or amortize them over certain periods versus actually seeing them as a legitimate operating expense that should all be incurred in the current period. And then looking at expense cutoff dates and not recording an expense until the cutoff date happened, and then that expense would be attributed to the next year versus the current year. Management understates and expenses to inflate profit. That's our opportunity. How do they conceal this? Inappropriately capitalizing expenses to an asset account. How can we prevent this? Segregation of duties in the general ledger system and requiring appropriate approval in the ledger system for all expenses. So when I worked in mining and we were responsible for some sales journal entries, all journal entries had to be approved by a manager, and then they were also approved by the corporate accounting department. So there was multiple stages of approval to verify that the expenses were real. The detective controls that can be used are data analytics to require significant capitalization during the year and reviewing the appropriateness of the capitalization, and using vertical and horizontal analysis to see if there's any strange patterns occurring. And basically, expense cutoff is reverse of our revenue cutoff. You're taking this year's expense and rolling it over into the next fiscal year rather than reporting it. When we postpone recognition of expenses until the subsequent accounting period, management has the opportunity to understate expenses and inflate profit. How do we prevent this? Implementing controls that prevent post-dating of journal entries, and then implementing policies about the timeliness of recording journal entries. So making sure that journal entries are made as soon as maybe a payment occurs or a contract is made with a vendor. Detective controls, you can use data analytics to summarize expenses at the beginning of the future year to see if they are unusually high, or if you already have expenses that you're recording in the next year, even though the year has not occurred yet. And then vertical and horizontal analysis can show that, oh, maybe our expenses are much lower this year. What's going on? We didn't change how we run the business. Always look at financial data in light of the context and what is occurring internally in the organization and externally in their environment. So understanding financial performance, understating, sorry. So there are a few reasons management might want to understate the company's financial performance. One is to decrease the amount owed in taxes. Another might be to reduce the amount of money that's going to be distributed in dividends to shareholders if they have certain profit thresholds that will then facilitate dividends. To defer earnings to subsequent period if current goals have not been met. There's a lot of literature in accounting and research that looks at this. And this has actually coined the taking a bath, because basically what occurs is if managers know that they're not going to reach their goals and they are not going to meet their bonus target, and they're not going to get a bonus this year, they might take a bath. So just basically have a really bad year and shift the profits from the current year to the next year to increase their chances or likelihood of getting a bonus in the subsequent year. And then the other reason that organizations might understate financial performance is to reduce investors' current expectations to create perception of growth. Like, look what an amazing manager I am. I grew this company profits or revenues by 100 million or something like that. So fraud schemes to understate or overstate company performance. For overstatement, you have fictitious revenue and concealed expenses. On the other side, to understate financial performance, you will understate revenue and you will overstate expenses. So there's flip sides of basically the same coin. So understating revenue, there are 3 notable fraud schemes related to understating revenue. One is the misclassification of revenue. So a company understates revenue by inappropriately recognizing revenue as a different type of income. So it will show after operating income as maybe a gain or something like that. You can play with sales cutoff. So rather than recognizing sales when the revenue is earned, the company can inappropriately defer revenue recognition until a subsequent accounting period. Or there could be some unrecorded revenue. So this involves not documenting sales or destroying sales documentation and diverting funds, especially cash, somewhere else. So control activities to prevent this. When revenue is recorded as a capital gain transaction instead of an income producing transaction, some preventative controls to stop this could be implementing segregation of duties in the ledger system and requiring appropriate approvals for recording transactions. Detection controls, you can have data analytics performing trend analysis of revenues from previous years to identify unusually low sales in the current year that are not justified by something occurring internally or externally in the environment. And then you can always use the vertical or horizontal financial statement analysis to reveal any strange patterns. When you're recording current sales in a subsequent period, to prevent this, you can implement controls that prevent recording or manipulating journal entries past the cutoff date. You can use segregation of duties to make sure that one person isn't responsible for all the steps, and then having multiple people involved by having approvals occurring. To detect this, once again, you can use data analytics to review the journal and ledger entries to make sure there's nothing post-dated, and then vertical and horizontal financial statement analysis. Another type of activity that can occur to understate revenue is just failing to record transactions. Preventative controls could be electronic fund transfers directly to the bank, use of cash register or point of sale devices that show a record of all sales, preparing a pre-list of mail receipts, and restricting endorsing checks immediately to ensure independent agreement of pre-list with bank deposit, and conducting bank reconciliations can prevent this kind of fraud. And how do we detect it? We can look at data analytics and perform time trend analysis of revenue from previous years to identify unusually low sales periods in the current year, and looking at those financial statements and analyzing them both vertically and horizontally. Another way to understate a business performance is to overstate expenses. So there are a couple of ways companies might overstate their expenses. So they might expense capitalize costs. So rather than taking that equipment and capitalizing it and then amortizing it over the years, they might take the equipment as an operating expense and incur the whole cost in the current year. So when organizations expense capitalized costs, they recognize capital costs that should be recorded as an asset, as an expense, thus reducing net income. Another way to overstate expenses is to use expense cutoff, and this involves overstating expenses by prematurely recording them in the current accounting period rather than in a subsequent period. So here are some detective and preventative controls that organizations can use to stop this behavior. So the method to conceal the overstatement of expenses can include inappropriately expensing costs that should be capitalized as an asset, To prevent this, you can have segregation of duties, so multiple people are involved in this process, and requiring appropriate approval in the system to make sure that all expenses are written properly and there is documentation to them. Detective controls, you can use data analytics to look at trends that show that expenses might be overly high. And then vertical and horizontal financial statement analysis. If management prematurely reports expenses from a subsequent period into the current period, ways to prevent this is once again implementing system controls that look at date of the journal entries, having segregation of duties so multiple people are involved in this process, and requiring approvals and sign-offs on the general ledger. How can we detect this? We can use data analytics to look at a summary of the expenses for the current period to make sure they make sense, and using vertical or horizontal analysis to look at any trends, anomalies, and outliers. Management involvement. Management override occurs when management decides to ignore controls that are in place. It's a big concern to a company's internal control environment and should be considered at the forefront of fraud risk assessments. Many frauds that occurred in the early 2000s were due to management overrides. That is it. I hope you enjoyed this lecture and found it helpful. If you have any questions or concerns, please send me an email and I will happily meet with you. Don't worry about any other fraud. The key is that fraud, many organizations experience fraud. Basically, every organization is susceptible to fraud, but adequate control environment can mitigate fraud and prevent fraud. And AIS systems can be used to do this, and data analytics can be used to prevent fraud and detect fraud as well. Okay, have a great day, and I will see you in class. Bye, everyone. Take care.